Chapter 4, Forms of Ownership. There are different forms of real estate ownership. Some forms include sole ownership, either by an individual or a business, concurrent ownership, and ownership by trust. Here's a graphic reproduced from the textbook. Let's start with sole ownership. If by an individual, then that means title held by one person. In Louisiana, we call that sole ownership, we call it estate in severalty. Ownership by a single person offers flexibility because that one person doesn't have to answer to anyone else. We can also have sole ownership by a singular business, and some of these business forms include a partnership. A partnership is two or more persons engaged in a business for a profit. Some types of partnerships include the general partnership. With the general partnership, each partner faces unlimited liability. In other words, each partner can lose more than what they've invested in the partnership because any liability of this business becomes the liability of each partner. Furthermore, one of the advantages of the general partnership is that income is taxed at the partner level. The business itself does not pay any taxes. There's also what's known as the limited partnership. With the limited partnership, some partners, well, at least one partner in the limited partnership must be a general partner with unlimited liability. The remainder of the partners, however, are limited partners. While they might provide the bulk of the capital in this business and they share in profits and losses, their liability is limited to what they've invested in the partnership. Unfortunately, they are limited in their role in management. If these limited partners become too involved in what goes on in the operations of the partnership, those limited partners would become general partners. There's also what's known as the limited liability partnership, and that limits the liability of some of the general partners. So it sort of offers the best of both worlds in that it will have some general partners and some limited partners in the limited liability partnership. But with the limited liability partnership, those general partners do have some limits or some floors on the amount of losses that they have to endure. Finally, a joint venture is a partnership to carry out only one project. Some additional ownership forms, sole ownership forms, is the corporation. A corporation is a legal entity created by a state, and ownership is evidenced via stock. We have what's called the C corporation. The C corporation offers limited liability to all of its stockholders, but unfortunately there are some downfalls to the C corporation in that income to the C corporation is taxed twice. It is taxed at the corporate level, and then when those earnings are passed along to shareholders in the form of dividends, those shareholders have to pay taxes again on the same income. So income is taxed 2 times, at the corporate level and at the shareholder level. Furthermore, any tax benefits that the corporation enjoys is trapped within that ownership form. It is not passed along to the owners or to the shareholders. The S corporation, the subchapter S corporation, is popular for real estate brokers and developers. It allows up to 75 shareholders. It offers limited liability, and earnings are taxed only one time, and that's at the ownership or at the shareholder level. The limited liability corporation is similar to the subchapter S corporation, but there's no limit on the number of stockholders. When it comes to concurrent ownership, different states in the United States recognize these different forms. Not all states recognize all forms. So let's get on concurrent forms of ownership. The first is what's called tenants in common. This is shared ownership of a single property among 2 or more people or entities where interests need not be equal and no right of survivorship exists. Okay. Well, let's kind of deconstruct this definition where it says where interests need not be equal. If it is not mentioned in this form of ownership, well, then it is equal. If it is not equal, it needs to be mentioned as to how the tenants own their proportionate share. A couple of terms that we also need to define: an undivided interest. That means ownership by 2 or more persons that gives each the right to use the entire property. They may not own the entire property. One may have an unequal share versus the others, but an undivided interest means the right to use it, not how much you own of that property. And then there's the right of survivorship. The tenants in common form of ownership, of concurrent ownership, has no right of survivorship. That means if a co-owner dies, his interest passes to his heirs or devisees, who then become tenants in common with the remaining co-owners. So let's see what this looks like. Let's say that we have one parcel of land with 3 owners, A, B, and C, with unity of possession. What happens if C dies? Well, if this form of concurrent ownership is set up as a tenancy in common, when C dies, A retains his share, B retains his share in this property, but C's ownership is passed along to C's heirs, so there is no right of survivorship. With the tenancy in common, each owner has a separate title to an undivided interest. That means each can sell, mortgage, give, devise his or her interests separately. Remember, there is no right of survivorship. And in terms of the percentage of ownership, it will be equal if it is not specified. If it is not equal, it should be specified in the deed. Another concurrent form of ownership is what's called the joint tenancy. And the joint tenancy features the right of survivorship. That means that the surviving joint tenants automatically acquire all the rights, title, and interests of the deceased joint tenant. This is also known, joint tenancy is also known as the poor man's will. So let's see. So we have one parcel of real estate, A, B, C. Okay. All three owners with 4 unities: possession, interest, time, and title. That means in terms of possession, they each enjoy undivided possession of the whole. In terms of interest, all of our owners own one interest together. Time means that they've all acquired their interest at the same time. And in terms of the unity of title, all have acquired interest from the same source. Now, what happens if C dies? What happens to C's interest? Well, in this case, C's interest would be divided up between the remaining joint tenants, A and B. So that means, again, that joint tenancy has the right of survivorship. What about concurrent forms of ownership between married persons? Some forms of concurrent ownership between married persons include tenancy by the entirety and community property. So let's distinguish between the two. Tenancy by the entirety has the right of survivorship. There is no disposable interest during the lifetime of the spouse, and in the event of a divorce, spouses become tenants in common. On the other hand, community property is joint ownership of property by spouses, and each is treated as an equal partner. Different states recognize different forms of concurrent ownership between married persons. In Louisiana, we recognize community property. And as far as the previous forms of concurrent ownership, tenants in common and joint tenancy, and of course tenancy by the entirety, these forms are not recognized in the state of Louisiana. So let's get back to community property. That is joint ownership of property by spouses, and each is treated as an equal partner. In other words, each owns half of the property acquired during marriage. The spouses are 2 equal partners. However, community property allows for separate property, and each spouse that owns separate property can do as they please with that separate property. But what is separate property? Separate property is property acquired before marriage, property that's acquired by gift to a spouse, property acquired via an inheritance, or property acquired by separate funds. So separate property is different from community property. Community property states recognize that each spouse owns half of the property acquired during marriage, but those states also recognize the existence of separate property. Spouses, however, in community property states must be aware of commingling. What was once considered separate property could be construed in a court of law as community property if the separate property is somehow commingled with the community property. Therefore, it is very important for spouses to keep detailed and accurate records regarding separate property. What about trusts? Trusts are another concurrent, or it's a completely separate type of ownership. A trust is a form of ownership used to provide for the well-being of another. Basically, this is an arrangement whereby title to real personal property is transferred by its owner, that's the trustor, to a trustee. The trustee holds title and manages the property for the benefit of another, and that would be the beneficiary. The different types of trusts include the inter vivos trust, which is a trust that takes effect during the life of the creator. The testamentary trust is a trust that takes effect after the death of its creator. A land trust is the management of property by another, hence the trustee and the trustor cannot be the same person. And finally, the real estate investment trust, which is sort of like a mutual fund for real estate, and that many investors can come together and buy shares in the REIT, or the REIT, the Real Estate Investment Trust. So you don't have to be a big spender. You can make a small investment along with others that make small investments, and then that trust invests in real estate and real estate related assets. And the REIT manages this money. A syndication is simply a broad term that refers to two or more individuals who have combined to pursue an investment enterprise that's just too large for any of them to undertake individually. As we close Chapter 4, here are some different terms which you should become familiar with. If you have any questions, don't hesitate to ask.